Hello, people from Earth, and welcome back to another episode of growing my account from 10K to 100K. So, I haven't made any investments yet. Well, that's because it's weekends and I've last uploaded, I think, on Friday. So, what I'm gonna do today is basically share with you my weekly market sort of update, as you per se, to get a sense of what's gonna happen next week and what my plans are, what my thoughts are. So, basically, right, if you go over my Google Docs, right, there are two ways of investing, right? First is top down. So top down basically means you look at investing from a macro or economic perspective. So you look into like what sector is gonna behave well, gonna perform well, gonna perform badly, depending on the entire market economics and how countries are performing and things like that. So I think macro is incredibly hard to predict, right? So even your like a world-renowned economist gets it wrong. How many people has predicted the stock market crash? But nothing has happened so far. Even the Fed has got inflation sort of wrong back in 2021, 2022, where they held interest rates too high for too long, which led to the market crashing and things like that. And I think that said, I think it's very important to understand what's happening in the current market environment for you to spot opportunities. So, for example, right, in the case of say a geopolitical event where there's a war somewhere, and you could use that opportunity to understand that maybe political news sometimes leads to quick market drawdowns, but doesn't necessarily stay. So there's an opportunity for you to go long onto your companies that you are have been thinking of adding into positions or entering positions. So all this economic news, right? It may affect a certain country. It may not directly impact the company that you are going to invest in its business and operations. So it is sort of, I would say, an opportunity to buy in, especially for normal retail investors like us. So secondly, right, it's a bottom up investing, which basically is your stock picking. You're gonna deep dive into a company's fundamentals, look at its valuations, whether this company is attractive for you to invest in, to to meet the criteria that you have over the time periods that you are looking to invest into the company into. So what I usually do, right, is to get a sense of what's happening next week. So basically, it's actually the economic calendar for the week ahead. So basically, this whole, like, let me zoom in a little. This calendar, right, you can get it from forexfactory.com. So it will rank according to you nicely. You can filter by this as well and how the severity and impact uh, of economic news that's reporting Next week. So if you look at the calendar, I think next week, right, there's only going to be one thing in focus, which is CPI, your inflation data. So this is particularly essential for markets going ahead because well, the next rate cut, I think in mid-September, is more or less guaranteed. But whether there will be certainty on the predetermined cutting path going ahead is another. So like I mentioned in previous videos, the markets and investors like certainty. So if Powell gives a sense of confidence of that he's going to cut more rates than expected, or even like meeting market expectations, right? Markets could either continue the steady grind upwards or just shoot higher. But if Powell is gonna go back on his on his words, as you can say, oh, they're gonna be data dependent again, things like that. It may create some form of jittery, and I think it aligns nicely with September being a historically weak month. So I think this could be an opportunity to take advantage of this volatility. I think it's also very important because last Friday's job numbers were a lot weaker than expected. I think there were only 22K jobs added where there was expectation of 75K. So this means that the economy is starting to slow down. So the Fed actually looks at two main data points when they are looking whether to cut or increase interest rate. Right, it is inflation and job numbers. So job numbers are showing um was sort of signaling the Fed to go ahead with rate cuts because it's weaker than expected. And inflation, right, is going to be the next, I think, nail in the coffin. So if the next CPI comes out to be weaker than expected, I think the markets will continue rallying because of rate cuts expectations. So number two, right, would be the Fed chair seats. So I think Powell is probably not going to be continuing his term as the next Fed chair. Probably Trump's going to elect someone that's uh, very close to his agenda. So I think whoever's replacing the chair as the replacing Powell as the next Fed chair will most likely be someone who's aligned with Trump's mandate of keeping interest rates low. Well, unless there's a shock here, I don't think it's going to influence markets much. And thirdly, I think it will be earnings. So earnings, you can look at stockpenguin.com's earnings calendar. Over here, you can look at what companies reporting the next week and what are their expected, like their earnings per share, revenue, and whether there's a surprise or not. So next week, right? I've already done the filtering. I think it's a pretty muted week. Only two companies earnings would I think be uh sort of will influence the market a bit, which is Oracle and Adobe. Oracle because it's also quite a big AI name, right? And whole market is now driven on the whole AI narrative. So if Oracle's results are starting to show weakness or it doesn't beat expectations, things like that, and its guidance for AI related sales are weak, it could pull markets down a little. And same case for Adobe as well. But I think Adobe is not really part of the whole AI narrative for now. They're just part of the legacy names that are being disrupted by AI. So if Adobe comes up with any like new products guidances that are stronger than expected, it could help boost the stock's price in the near term, especially because since Adobe has been another beaten down stock for the past I think couple of months or even a year, right? And it's been a favorite of deep buyers. Other than that, there is an interesting name, GameStop. So if you're like an ape, right, this is something that you can look out for. But I think Wall Street Bets has moved on to other names such as your Open Door and things like that. So GME, I think probably the earnings won't move it as much, but I'm not really caught up with that scene, so don't quote me on this. And I think aside from that, I like to do a weekly market pulse check, which is the fear and greed index. One key example with the fear and greed index. So currently we're sitting at neutral. I think this is because markets are still awaiting a certainty on the Fed rate cuts, as I mentioned earlier. Yep. As you can see, market momentum is sort of neutral, but one thing to note that if you're a technical guy, the S&P 500 is overly extended, very far away from its 125-day moving average. So if anything bad happens, right, markets could pull back down quite heavily, and this could present an opportunity for long-term investors, right? Yep. Stock price strength. A lot of stocks are nearing its near 52 weeks high, which sort of shows an extreme greed situation, but it is not yet at high seen previously. But so I think it's shouldn't take into account this too much, right? Stock price breadth really just accounts for how many stocks are advancing in the index versus declining. So I think at this rate, I think it's still pretty normal, acceptable range, nothing too dangerous. Puts versus calls shows a pretty neutral situation, right? There's nothing extreme like back in April where you have your terrorist related announcements which created a lot of volatility in the market, so people needed to hedge quickly. So I think this is a pretty normal situation. But the VIX is near its local lows. So like I mentioned, maybe the Fed's announcement or CPI next week could create some form of volatility, which I think we should, as retail investors, we can only take advantage of by buying the dip, right, as per usual, right? So another tool, right, that I like to use to judge the market's expectations on interest rate, right, is this uh Fed cut rate cut probability. So this is accessed from going to this website. So I like to Google just count out the FOMC. It's called Fed Watch, provided by CME Group. So CME Group is like an exchange, right? And yeah, over here you can see what the probability of interest rates being at the next rate cut. So the 25 bips is more or less guaranteed for the next rate cut, right? At about near 90%. So the markets are very um more or less very confident that the Fed will cut rates. So if anything, any surprises happens, that maybe the Fed pauses, which I don't think will happen, or even raise rates, you would expect like the markets to tank immediately because that's against the overall positioning of all the participants in the market. All right, so markets are still heavily pricing in about three more rate cuts by the end of the year. So, like I mentioned earlier, if Powell doesn't present any form of certainty in his next monetary Fed monetary announcement and statements, right, then markets could be shaken a little because of the lack of certainty, and everybody is expecting him to cut. And if it goes against that, then markets would dip. But the thing is, it all depends, I think, heavily on the next inflation print, which I think will give Powell the confidence to be a little more certain, right? Almost the time he likes to say like, "Oh, we need to look at data, we need to look at data," but if the next one gives a good inflation print, I think he would be more confident to cut rates further, and the markets will probably rally after that. Another thing I like to look at is the FINRA margin debt. So this is just basically a sense of how much leverage are being used by people, right? So it is back to your July 21st high, which nicely coincides with the previous bull market peak before there was a pullback. But I wouldn't take this too greatly into account because, as you can see, the next chart, money supply has increased over time. So you could expect that there will also be more leverage in the whole in the economy. But of course, wouldn't want to see this like just shooting up suddenly. But a little more gradual would be nicer, which I think is currently happening now. So I think we could skip this FINRA margin debt and M2 money supply. Another thing I like to look at is the treasury yields versus the Fed fund rate. So how market participants are pricing in bond yields, right? So you can see last week after the job numbers that turned out bad, yields immediately tanked. So I think there are greater expectations of the market by the markets on Powell cutting rates, which I think is more or less going to happen. So yeah, wouldn't expect too much shock over here. Yeah, Schiller PE ratio, something I like to look at. I think it's a metric that Warren Buffett likes to track as well. It's near the previous peak of the great the just before COVID, right? There was a crash. So I think it doesn't look too healthy, but then again, like I mentioned in the previous video, because of the advancements in AI and how just a lot more money supply out there now, I think um we could don't pay as much attention to Schiller PE ratios in your valuation metrics, things like that, but to manage it from an individual bottom up company perspective, because I think the index as a whole will get inflated over time as there's more money pouring into the system. Yep. PE ratio, which is different from the Schiller PE ratio, still looks healthy to me. There is still room to head up higher, though it's more somewhat slightly above the historical average. Price to sales, it's gonna just shooting up because I think of like I mentioned earlier, money supply. Right. And another thing I like to look at is the COT net positioning of market participants. So this is accessed by going to cotbase.com. So over here, you can look into for example, if I look at the stock indices, S&P 500, you can look into the positioning of market participants. Sorry, it's not loading. Let's try again. Oh, it's not loading, but luckily I've already taken screenshots, right? So it's looking to the net positions by your commercials, your large speculators, and your small speculators. So over here you can tell how bullish or bearish they are, and I usually use this to gauge extreme sentiments in the market. So if you see things like your commercials are very long, heavily long, your large speculators are heavily short, things like that, it presents an extreme position where the market could turn or reverse its current trajectory. So as of now, positionings are not that extreme, though near extremes, right? But small speculators are still pretty flat. So I think there is an opportunity for the markets to reverse, but I only use this as a gauge. I think it's more important to judge what's going to happen based on the next federal announcement, Fed rate cut announcement. But for now, I think we have to be aware that there is an opportunity to reverse, especially we're in September, and VIX is also quite low. So any reversal, I think, is an opportunity to go long, unless we get an extreme situation happening with the Fed rate cuts. Yeah, same thing for the Nasdaq. It's really sluggish as well, but I think it's a better spot compared to the SPY because there's no extreme situation. But what I like to bring your attention to is the small caps. So uh, small speculators are going long, and you can see that there is a closing continuation of the current trajectory of the commercials and large speculators positioning. So I think this presents an opportunity for small caps to continue going back higher and continue its trending. This could mean that there's more capital flowing from your large caps to your smaller caps as all of these small growth companies, fast growing company catches up to the your large caps. right? So this is basically it. The other stuff I look at are just your commodities, your cryptocurrencies. Yeah, but I don't think it really impacts your stocks that much. So I have some quick takes. So US indices, I think mostly neutral for now, but small caps are showing the most potential to go long. So and I think it will depend on inflation data next week, right? And what I'm looking at in terms of your fund, your technicals, right? There are some companies that I am keen to deep dive further into, and I'll just name three of them for now. Number one, Zeta, as mentioned in my previous video, it looks like it's consolidating before it breaks out higher, and goes back to the previous $26 range. So I think there's an opportunity to go long here if it breaks out, or even if it retests its previous gap support, or yeah, it just fills a gap for you to go long. Secondly, another company that I'm looking at is called Root. So if a Root, if I'm not wrong, it's a fintech company dealing with insurance, right? I think it's been consolidating for the past couple of sessions, and it could, go back up to cover this small gap over here. So Root, I've looked into its fundamentals on stockpenguins.com's tool, right? It looks pretty healthy to me for a high growth company, right? See, let's go to the legacy view. Valuations, PE looks okay. Price to sale looks okay for a company that's growing pretty steadily. You look at its chart views, right? 5 years, quarterly. It's growing pretty decently, 10% quarter over quarter. Profitable, right? Net income growing as well. Free cash flow positive, and increased 94% year over year. So this is a company that I could, take a small starter position in just because of its how it's showing up fundamentally. But this is a disclaimer, it's not financial advice. I'm gonna take a very small position only to have some skin in the game to continue my research. Another company I think is a company that everybody is talking about now, Novo Nordisk. I think it presents an opportunity to go build a position for the longer term, because I think it's a contrarian position where everybody is like hating on the healthcare sector. But the company, if you look at its fundamentals, right, it's still growing very steadily. It's still a market dominant leader, and it is in the evergreen, ever expanding healthcare space. So I think this is a company that's good to be a long term position in, especially if it starts to revert back to its mean, which I feel it could at least hit your $68, which presents a serious decent return, right? Yep. So I think that's it. This is my plan for next week. Generally cautiously bullish until inflation data tells me otherwise. Thank you.